In this presentation, we will discuss the master budget. This will be a long presentation. If you would like to jump to relevant parts within it, take a look at the description below, which will have links to those relevant parts as well as a discussion of what will be included within them. In this presentation, we will discuss the question of why budget. In other words, what are the benefits of budgeting? One of the primary objectives is to have a future orientation, a future analysis, a future look, to give everybody in the company an idea of where the company is going in general, and then a map in terms of how are we going to get to that future objective. This seems obvious, but if we take a look at different departments, it's not as obvious as we might think, because part of a company's objective is to divide tasks up by department, and different departments are really geared towards what they're doing on a day-to-day type basis. So it's management's job then to have that future orientation, to be looking into the future, to be planning that endpoint, to be planning where the company is going, what's the direction of the company from an overarching type of standpoint, and then help the others to see that overarching standpoint within different departments, so that each department, although they are looking for the day-to-day goals, and you'll note that many supervisors that are working within a particular department are really managing the day-to-day. They're trying to get through the day, manage all the problems that happen on a day-to-day basis. It's not really the management's job all the time of a particular department to take the step back and have that big picture vision. That's what the upper management is there to do, to have that big picture vision and then align all the management together with that. In order to apply that big picture vision, however, we do want to have everybody in the company to have a glimpse and have participation, be able to see what that big picture is, so that when we go into those day-to-day tasks, when we go into the things that we got to do each day, when we solve those problems each day, we have at least in the back of our mind the big picture focused, and we can take actions that are in alignment with the big picture focus, even if possibly they don't line up with the exact policy that we are looking at, or the exact rule, or if there is no rule for one set or circumstance that happens. If we have a big picture focus, a big picture view, then people that are managing particular departments can then say, okay, I know what to do within this situation because it's in alignment, it's in congruity with our big picture goals and objectives. Another big objective is to communicate the plans with the organization. So we want to be able to have the plans, and oftentimes we think of top management coming together with a strategic plan that they're then going to implement. But in order to implement the plan, we really need to be able to communicate the plan. And the communication of the plan will have a lot of different effects as we go into this process. Note, when we have the budget as well, the budgeting process should be a communication project in and of itself, because that helps with the flow of ideas, with the flow of communication, both up from the bottom up to management, as well from the top management on down, in terms of the communication of the final direction that we can then be clear on and going forward and be able to put together the steps that will be necessary in order to move forward in an efficient way. Therefore, the creation of the budget should be one that has communication with that creation, so everybody feels like they have their input in the budget, that they're part of the budget, they're part of the plan, and the execution of the plan then they are personally invested in. Once the plan has been made, then it's the job of management to clearly define what the plan is once the budget committee has come up with the plan, so that everybody is fully aware of it, everybody can be in congruency with it, and everybody can take steps along the way in the future as the future unfolds in accordance with the steps that have been laid out with the plan, with the budget. The budget should also make those long-term strategic plans into more short-term financial plans. So it's going to be the job of management to have an idea of what the long-term plan for the company is. What's the 5-year, what's the 10-year plan for the company? Those overarching plans, the objectives, the goals of the company, the mission statement of the company, and then break those down into smaller chunks, because the smaller chunks are the actual roadmap that we can see. We can see only part of the road as we go forward, and therefore we need to zoom in on that part of the road so we are conscious of what we are doing. We're focused in on the steps that we need to take going forward, while keeping in mind, especially upper management keeping in mind, but also communicating to the rest of the company what the overarching goal, what the 5-year goal, what the 10-year goal is. We want to have the overarching vision of where the company is going, but then the budget, of course, is there to break that down into digestible chunks that we can then see clearly going forward, chunks that people within the company then know and can use in order to make the steps and decisions in the immediate future, in the next month, in the next year, in the next week, in the next day. Another objective of the budget is to provide a benchmark that we can then use to measure actual performance against. So in other words, when we make the budget, we're saying this is what should happen. This is what we think is going to happen. We want to make that as numerical as possible because numerical items are easy for us to then compare. In other words, we say this is what we think should happen. If we can measure it in terms of dollars, that's very concrete. That's easy to measure. Then we say, hey, this is what actually happened at the end of the time period that we had previously budgeted for. And of course, the difference between those two is something that we can then look into and think about and consider why, so that we can then make another budget for the next period and move on and on and on in this fashion, hopefully improving, and improving. Another major goal of the budgeting process, and one that's often overlooked, is the motivation of employees through participation. It's often thought that the budget's going to be applied from a top-down type of perspective, and sometimes it is, but we want to be careful of that because we really want to have the bottom-up type of feedback. We want to make the budgeting process a communication process because it's a really big opportunity for us to have that communication process. We want to be able to have all places within the company be able to give feedback so they feel like they're invested in the plan. They've contributed to the plan. They are part of the goal that has been taken on through the budgeting process, and therefore they're personally invested in the outcome. The only way to do that is to really get the feedback from everybody within the budgeting process. So the budgeting process, huge opportunity for communication to help everybody to feel heard. It does not mean, of course, that it's going to be a democratic process and we're all going to take a vote and decide what the budget is, but it does mean that the process of creating the budget should be in a systematic way, and the governing of the process should be in the format of how can we get the best information. And everybody in the company should hopefully know that the budgeting process is designed with that end goal in mind, to get all the information. That's what the budgeting process is for. And then, of course, the final decision is made, by management. Once the budget has been completed, then hopefully everybody feels like they have invested, that they have been communicated with well to that they've been able to contribute, and that any kind of response to the budget and any decision that has been made has been well communicated, hopefully in a way that addresses any consenting viewpoints so that everybody feels invested in the budget, and then the implementation of the budget can happen, and management then wants to implement the budget and make sure that the plan is then executed. Once the decision has been made, once the budget is set down and we're moving forward with it, then we want to make sure that the plans of the budget are clearly communicated. The process of making the budget now having been ended, now we're in the implementation of the budget, and want to make sure that the implementation, the communication of the goals of it are now communicated from management to the employees in a way that everybody understands what those goals and objectives that everybody has decided and invested in are. So to recap our budget objectives, it should promote future analysis, thought, and direction. So it has everybody kind of focused on the goals of the company and the goals that are going to be the future orientation. So if there's any question on the day-to-day type of activities that can happen, they should have some idea. We should have some idea of what to do given the overarching vision, the overarching goals and objectives of the budget and the company. Communicates the plan to the organization. So the organization, everybody within the organization hopefully has a good idea of what the budget is, how to act within the budgeting process, what their department is required to do within that budgeting process, because those steps have been well communicated. Make long-term strategic plans into short-term financial plans. So we want to have an overarching vision. Upper management does, of course, want to communicate that vision, but also want to communicate how we're going to get there on a step-by-step, year-by-year, month-by-month, day-by-day type of basis, so that people within the organization can then see the overarching vision, but also what they got to do immediately. They see the road in front of them, how to take each step as they go along the way. Provides benchmarks for evaluation. We should be able to compare what we do on the budget to what actually happens, that giving us feedback on our progress so that we can then make another budget. and it motivates employees through participation. It really should be a communal kind of activity. If it is, it's a huge benefit, huge opportunity for everybody to feel like they put some feedback into the budget, not necessarily feeling like the budget did everything that they wanted. That's obviously not going to happen, but feeling like the process was good, process was geared to get communication, to get feedback, and all of that feedback hopefully was addressed, and therefore people feel like it was a good process to go through, and therefore are invested in the plan. And then once the plan is implemented, they will feel invested in carrying out the plan and achieving the goals and objectives of the budget. In this presentation, we will discuss budget problems or potential pitfalls within the budgeting process that we want to be aware of, that we want to avoid. One problem with the budget is that there is an inherent incentive within the budgeting process, often to try to understate the sales that will be budgeted for and overstate the expenses. Why? Because that will make it easier to hit the target. So if you're imagining the budgeting process as the management, the upper management is there to, of course, approve the budgeting process, communicate the process of making the budget, and then we've got the managing department managers of each department and supervisors of each section of the company, then coming up with the budgets for their particular department, their particular segment of the company. Those department managers have an incentive, you would think, to do things like understate the sales and overstate the expenses, because if they do so on the budget, then it'll be easier to hit that target and they'll look good to hit the target. In other words, if they overstate the sales that they're going to make in their department and understate the expenses, that's what we would want. We would want sales to be high. We would want the expenses to be low. Then it'll be harder to hit that. And if they don't hit the target, then they look bad. If they set a low target that's easy to hit, low sales and high expenses, then lower sales and higher expenses than they know they can achieve, then it'll be easier to hit the target. And when they hit the target, it will look better. So that's just an inherent problem within the budgeting process. And we have to be aware of it, and we have to be aware of the fact that we want to make sure that we have motivated departments to basically set a budget that has a target that is not too high, but achievable. And we want to be able to incentivize management to set the target in a place that's reasonable, so that they have the incentive, so that they can inspire their department to shoot for a reasonable target rather than undershooting it. And we have to basically make that part of the culture of the organization to say, hey, we're gonna reward you more. We're looking for management that's looking to make a reasonable type of budget. We'd rather have someone make a budget that's a little too high and miss it than make a budget that's going to be too low just so that they can hit it. Another problem inherent in the budgeting process is that we typically want to set those budgeting goals in such a fashion that there's going to be a challenging growth pattern in it. So typically when we consider the budget, we're considering a smooth growth trend. That's what we like to see within the sales. We want to see the sales, we want to see the net sales going up in a nice smooth pattern. Another problem inherent to the budgeting process is that pressure could lead people to unethical behavior. In other words, we want to set the budget to a point that's going to be difficult for people to meet, but still meetable. And we often want to see some kind of trend that's going to be a normal kind of uptrend in process. We want to see improvement over time, continuous improvement over time. And if there's going to be compensation objectives related to that, such as bonuses, for hitting a certain objective, for hitting a certain mark, that can also add to a lot of pressure to make that mark. So as we set those high goals, because we need those high goals for maximum performance, we also need to be aware that people could be incentivized for unethical behavior. And again, it's got to be in the culture of the organization to be set that, hey, we would rather have someone miss the goal, even though we set these goals and we want people to strive for them, rather than do some unethical type of behavior in order to achieve the goal, and possibly doing things that could be fraudulent or deceiving the reports, or things that are going to sacrifice the long-term vision of the company in order to meet a short-term goal. What we don't want to have is have the long-term vision, the 5-year, the 10-year, being actually diminished or reduced or making it harder to reach, because people are doing things that are going to manipulate or harm that long-term vision in order to meet the short-term goal, simply because there's pressure of that short-term goal. We want to keep the long-term vision in view, in sight, and make sure that the culture of the organization sees that everything should line up with that long-term vision, even though we're shooting at these short-term goals. Another problem inherent in the budget, and we touched on this in the first item, is that the budget could lead to spending an amount that's going to be equal to the expenses that are allocated to that department. In other words, if we are budgeted or allocated some amount of expenses that we can spend in a particular department, then we have an incentive to make sure that we spend everything that's allocated to our department, because if we're not, it's very likely that we will not be allocated that much in the future. So in other words, you might see spending that doesn't need to happen. We might say, we need another planter here. We might need some more chairs here. This often happens at the end of the time period, at the end of the month, or at the end of the budgeting period, where you might see purchases that be a bit in excess. And it could be possibly because they're trying to make sure that they expend or spend all the money that has been allocated to them by the budget for that period, so that in the next period they can argue that they need the same amount of money. In other words, there's not really an incentive oftentimes for us to spend less money that has been allocated, budgeted to us, because we know that the following budget, the next budget that's going to be made, is going to be based in part on the prior period. And if we didn't spend all the money that was allocated to us in the prior period in our department, it's likely that we will see less in the budget. Again, we want to basically have communication within the budgeting process and make sure that we reward people for achieving their goals and making their goals and actually spending less in some way. So although the budgeting process has this problem kind of inherent in it, because we do have to allocate some expenses to departments in some way, we want to basically be aware of that and incentivize people, recognize people, notice people that are spending less than the amount allocated, and find some way to reward that as well. Another problem with the budget is it's difficult to find the best range for the budget. In other words, we want to have a range that's going to be high enough to challenge people, because that's where people maximize their performance. We want people to be challenged. That's when actually they feel better about themselves, because they get to do something in a challenging fashion and try to meet an objective that is a challenge to them. And of course, that's where the company gets the most benefit as well. But if you go too far on the goals and objectives and make them too difficult, then that will discourage people, and it will either stress them out, or it will make them say, hey, you know what, this is unachievable. The goals and objectives that are always being put out there are things and goals and objectives that everybody knows are not achievable, and that could lead to people just giving up and not trying at that point in time. So on one side of the spectrum, you have the goals and objectives being too low. If they're too low, you end up with people just basically relaxing and saying, I can clear this objective, no problem, and not pushing themselves. And when they're not pushing themselves, you're actually hurting the employees a lot of times, because they would actually benefit, whether they would admit to it or not, from a higher objective, because they would be able to achieve something that is difficult for them, and that usually gives benefit to the employees. And of course, obviously, it's best for the company as well. And again, if the objectives are too high, then you're going to discourage employees, and they're either going to get frustrated, they might leave, or they're just going to say they're just going to stick around and just stop trying. You'll end up with the same kind of scenario here with people not doing anything, because either they get stressed out and they leave and replaced, or they just say, hey, you know, the objectives that are given to us are always way too high. There's no way anybody can meet them, and therefore we might as well just do whatever we can do here. We don't have, in either way, on either side of the spectrum, we don't have the incentive for people to really strive for the goal. So what you want is to hit that sweet spot for people. And again, every person is different, so it's difficult to do. But you want to hit that spot where people are really trying for the goal. It's difficult for them, and yet it's not too difficult. It's not unachievable. And that's always a balancing act within the budgeting process. To recap then, some of the problems with the budgeting process that we want to be aware of as we go through it is there could be an incentive to understate sales budget and overstate expense budget to look good and hit the target. So there's an incentive for department managers to possibly lower the target of their budget to make something that would be easier to hit. So we want to be aware of that and make a culture to deal with that, and hopefully set up a culture so that people don't want to do that, want to make challenging goals for themselves and the company. There could be pressure could lead to unethical behavior to achieve goals. So when we set those high goals, again, we want to make sure that there's a culture within the company that says, hey, we'd rather have you not meet the goal than sacrifice the long-term vision of the company or do anything that would be unethical. Budgets could lead to spending budget amount even though it is not necessary, so budget is not reduced. In other words, it could lead to people saying, hey, this is how much was allocated for me to spend this period. I'm going to spend that amount no matter what, even if I don't have to, so that next period I am allocated at least the same amount. So we want to be aware of that. That's going to be a natural incentive within the budgeting process. Again, we want to set up a culture that says, hey, it would be good. We will reward you. We will recognize you if you do good, if you surpass what is expected in terms of the spending budget. And budgets that are not realistic can reduce morale, while budgets that are too easy to meet will not inspire growth. In other words, we want to make that budget that's somewhere in the sweet spot that departments can say, hey, I can meet that goal, but it's difficult. It's not something that I can easily meet. It's something that's going to be challenging. It's a challenge that people will hopefully want to take on and aspire to. In this presentation, we will discuss budget timing. Typically, the standard budget for most companies will cover a year. So we'll have the annual budget. We'll have the annual budget, which will cover the next year. We're looking into the future, of course. We're doing the budgeting process. We're looking for the future year. Once we have that future year budget in place, we'll often break that down into smaller chunks, those smaller chunks typically being a quarterly budget, and then possibly even smaller into monthly budgets. If we take that yearly budget and then break it down into quarterly and monthly, that gives us some feedback that then we can go on as we go through the year. So as we go through each month, as we go through each quarter, we can review what we're doing as we go. We can compare actual to what we budgeted to happen. We can see the variance or the difference, and we can make decisions and adjustments as we go through that year. So we can also envision it in this way. We would have the annual budget. That's going to be the overarching budget that we would then make. And then within that, we're going to have the quarterly budgets that will then break that annual budget into. And then we'll have the monthly budget. Then as we go through the year, every month, we can take a look at that monthly budget, do the comparison on the monthly budget. Every quarter, we can take a look at that, compare the actual to the budgeted amount for the quarterly budgets. And of course, do the same thing for the annual budget as well. Some companies may also prepare a rolling or continuous budget, and the idea of the rolling or continuous budget is for us to update the budget after each time period. So as a period goes by, say a quarter goes by or a month goes by, then we're going to update the budget so that we're always looking out a year into the future. So as the quarter goes by in our example here, we then recalculate the budget and we look out a year out, so that we're always looking out that year into the future. We're going to update the budget as we go, as we roll through the process. We'll do the same thing for the next quarter, so it would look something like this. We have the standard yearly budget, and then a quarter goes by. We're going to reset the budget. We're going to look out a year based on that new information. As we do this, you can see that it has a few benefits of it, and some costs, of course. One of the costs is it's going to be more expensive for us to think about how are we going to reset the budget after each period that goes by. One of the benefits is going to be that we can have that comparison as we go through this. We can have that whole communication process again as we reset the budget, as we think about how it goes out a year out. And we can always be thinking a year out into the future. So when we consider the budget, we're always kind of viewing 1 year out into the future. And you can think of it as a car driving down the road. You can only see as far out as your headlights go. Well, the headlights are always going, a year out into the future. They always have that standard set, that standard look as we are budgeting through the process. So we can think of those headlights staying out there, giving us that focus as we drive down the road. In this presentation, we will take a look at the budget committee as we go through the budgeting process. When we consider the corporate structure, we typically consider it as a top-down type of structure. We have the management, we have the top management, we have the middle management, then we have the supervisor. So we have the top management with the overarching goals and objectives. We've got the middle management that's going to help to oversee the supervisors, and then we have the supervisors typically focus on the day-to-day type of activities. They're managing the activities that happen on a day-to-day process. So we note that the company is not a democracy. We're not voting for what is going on. It's a top-down type of structure. It's a top-down type of organization. So we would think, given that the budget process would be something that possibly would be dictated by the top, and the top would then just tell the rest of the company the map of where we are going. And of course, the final decision on the budget, what budget process will be implemented, will be done by the top management. However, it's going to be important for top management in order to achieve all the objectives that we talked about through the budgeting process to get much of the information from the bottom up. That means that much of the information through the budgeting process will actually go from the bottom up, from the supervisors to the middle management to the upper management. And we could see this bottom up type approach as we apply the budgeting process that will meet many more of our objectives. So as we look at the objectives that we considered in a prior presentation, we can meet many more of those objectives by taking this bottom up type of approach. And there's a couple different things that we can meet. One is that it will involve everybody. If we have the decisions that are just made by top management and then top management implements those decisions, even if they're communicated well, even if management has a very good plan, they know what the plan is, even if they knew everything that's going on in the company and they made a perfect plan and then implemented the plan, it's very likely that people will not execute on that plan as well as they could, even if it's the perfect plan, even though it's communicated perfectly, because they don't feel invested in it. So that's going to be one problem. The other problem is, of course, that a company of just about any size, if we have multiple type of departments, and of course, as the company gets larger and larger, there's no way that the top management knows everything that's going to be involved in the budgeting process. It has to, as the company gets larger and larger, it has to be more decentralized. A lot of the information is going to have to go from the bottom up, because the people in the departments are the people that have the information necessary to make the budget or put the budget together. So the larger the company is, the more we're going to have to be dependent on the segments, the management of each department, the regional managers, to go in and say, okay, we're going to piece this thing up from the bottom up. We're going to get the budget information. Then we're going to put it together by region possibly. And then we'll take a look at it from a holistic type of standpoint. So from a logistics standpoint, then as the company gets larger, then you can have different segments and you're going to have to put things up by segment just from a logistics type of standpoint. It's also important that we want to have the communication, because remember that the communication is one of the big keys of the budget. So when we consider the communication process, rather than thinking of it, this would be the way that we kind of build the budget from the bottom up, as we take the information from the departments to possibly regions to possibly top management. But the budgeting process, we want to think of it as kind of an even type of process here. So obviously the end decision is going to be made by the top management, but a lot of the information is going to be made by the departments. And what we need is communication back and forth. So although the end decision is going to be made by the top management, we need the communication to be going back and forth, and the people that are directing the budget committee then aren't really there to make their end goal in the budgeting process. When we go through the budgeting process, isn't really to be the one to say, hey, this is it, this is the actual decision, or to be the one that really knows everything so that they can basically make the ultimate decision necessarily within the budgeting process. The important piece is the process. We need someone to manage and direct the process. So we have a lot of people involved here. The main goal is to put a process together that everybody feels invested in the process. Everybody feels that the process is geared towards the full benefit of the company, and everybody feels that they have been heard within the process and don't have any fear of putting the information into the process for it to be considered with the objective of the end result, the best result for the company in general. If people feel comfortable with the process, if they think that the process is fair, is justified, then they're typically going to be good with the outcome. So that means that when you consider the process of the budget committee meeting, what has to happen in terms of running it is for it to be ran in such a way that everybody feels that the process is fair, the process is good, they had the contribution. And then once the decision has been made, then the communication could then happen, and the decision-making process then stops then, because now the decision has been made. Hopefully everybody feels good about the process. It then can be communicated clearly by management at that point that, hey, the decision has been made. We've addressed everything that we can. Anybody that had a dissenting opinion, hopefully we've addressed that dissenting opinion. Decisions made now. Now we communicate the implementation of the budget process, of the plan that everybody has had feedback in and has implemented their information on. And at that point in time, it's the communication of the plan not the communication on how to put the plan together. Hello, in this lecture we're going to talk about the master budget. We're going to go through the sales budget, the production budget, and the materials budget. At the end of this, we will be able to list the components of the master budget, create the sales budget, create the production budget, and create the materials budget. So we're going to start off, we just want to look at the list and the activities that go through the master budget for a production company, a company that produces things. And this is similar to many types of budgets. When we think about the most basic type of budget, many people think of, well, let's take a look at the income statement, how we did last year, basically divided by 12, make some adjustments, and that will be our budget for the months going forward to the next year. That's the most basic kind of components of the budget, and that's how any budget kind of starts off. We're going to look at last time's material, what happened, how did we perform, and then make some adjustments into the future. As we get more sophisticated, of course, we want to think about other things into the future other than just past performance, like what's the economy going to be like, what are some changes, what's going to be the effect on the sales and our expenses and whatnot going forward. We're going to look at a production budget for a company that produces things, being more complex in many ways and being more linear in the way we have to build it because of the fact that we're producing things. And the same principles will apply to many different types of budget. So we're going to have to start off with the sales budget. That's the first place we need to start off, no matter what type of budget we have. How much are we going to sell? In terms of units of sale, if we produce inventory and sell inventory, we need to think about how many units we're going to sell and then how much revenue we're going to get on that. Even if we take it down to our personal budget, we want to think about, well, how much are we going to earn in the future time period? For many individuals and many businesses, the amount we may earn may be fairly constant. That's why we can take last year's performance and basically budget it forwards. But it may change as well. For many people, it may change. Our salary may vary, and that's the first thing we want to take a look at because we're going to base the rest of the budget on that. Then once we know how many units we're going to sell, we want to come up with the production budget. How much stuff are we going to produce in terms of like inventory? How many things do we need to produce? And you might be saying, well, that's easy. We know how many things we're going to sell, therefore we're just going to take how many things we're going to sell, that's how many we need to produce. And that would be the case if it was like our first year of production and we thought we were going to be very exact in our numbers, but we probably want to have a cushion to we want to produce more than we're going to sell in case that we sell more than we thought we were going to sell. And we also probably had stuff that we didn't sell last time. We had a cushion from last time. So we need to take those two things into consideration in terms of figuring out how many things we need to produce in order to meet the sales and these other kind of requirements that we want to have in terms of having a cushion in the inventory. Once we know how many things we're going to produce, then we can think about how much material we need to produce them. So let's say we're like making guitars or something. We know how many guitars we want to make. Now we need to figure out how much basically wood we want to put in. How much wood do we need to buy in terms of the production of the guitar? Same kind of inventory type of questions. And we have the same kind of problems. It's not just that we need to buy the amount of wood in order to produce that many guitars. We need to figure out, do we want to have an ending inventory of wood left over? Do we have any wood that's still in the inventory here? Same thing in terms of direct labor, which is a bit more straightforward. We're going to say how much direct labor will it take then to make these many units of production that we need to produce, and the overhead, all the other stuff that's going to be involved, what's going to be the budget for the overhead to produce this many units. This isn't directly tied out, it doesn't have to be happening next, but the capital expenditures, do we want to buy new larger pieces of equipment and things like this? We need to plan out whether we have the cash flow and whether we can finance any more large expenditures. And then the selling and administrative budget, these are going to be more the period costs. These are usually more costs that we can do kind of what we think about in a traditional budget. Look at what happened last time and project it forward because they're usually more fixed in nature rather than variable in nature along with the production. Then we can do the cash budget, the cash flow that will happen. And then we can kind of finally think about our budgeted balance sheet that we always think about, our budgeted income statement and our budget statement of cash flow. So here's the statements that we're going to create. And again, most of us think about the budget oftentimes in terms of the income statement. Here's how we're going to perform in the future in terms of the income statement. But if we break this out into this process, we can do this first and then create our standard balance sheets from these projections. All right, so we're going to start off with the sales budget. So sales budget here, and we'll just break through these first three and then we'll talk about the rest of the budgets at a later time. So sales budget. We're going to say we're going to do this for the quarter of July, August, and September. In July, we're going to say in units, we're going to sell 20,600 units. Now, how do we come up with that number? If it's a book problem, they're going to have to give us that number. And if it's real life, then we're going to have to project, well, how much did we produce last time period? What's our traditional sales for July? What's the market like in July? And all this kind of stuff, and come up with the amount of numbers that we're going to produce in units. We'll multiply that times how much we're going to charge per unit. And that will, of course, give us the dollar revenue. So we got the unit revenue, we got the dollar revenue. We'll do the same thing for August. We're going to say we're going to produce 19,600 units. Where do we come up with that number? Again, we're going to have to project it out and think, how did we do last year? What's the market like? How things can happen? But then we just multiply that times our 24, and we come up with the dollar amount for 7,400. Same for September. We're just going to project the 20,100. Book problem will give us that. In real life, we'll have to project that in some way. Probably a very significant process to do that. And we're going to have the 24, the sales price. That gives us the 482,400. Totals then would be 60,300 units, and we would have dollars in revenue of 1,447,200 in terms of revenue. Now that we know this, we can move forward. How much do we need to make? How many units do we need to make if we're going to sell this many units? And you might think, well, we need to make 60,300 if we're going to sell 60,300. But once again, think about the idea that we may have units that are already in here from last month, and we may want to have a cushion because we don't want to have exactly 60,300 units. We might sell more than that. We don't want to have a shortage in case we do better than we thought in terms of just the budget, just the plan here. So those two things being in the factor when we then calculate the production budget. So we have the sales budget up here. Now we're going to say the production budget. How much stuff in units do we need to produce? If we're producing guitars, how many guitars do we need to produce for this quarter? We're going to break it out by month. So we're going to say July. We're going to first do a calculation in terms of how much do we need in order to fulfill our cushion in terms of how much we want to have left over. We want to plan in to have a cushion in case we sell more than we thought. And so here's how we're going to do that. We're going to take the next month's sales. So in this case, it was the 19.6, 19.6. We're going to take the August 20,100, 20,100, 20,100. We're going to have to estimate what it would be for October and then put in the units for October and September. We're taking next month's totals in terms of unit sales, multiplying that times 80%. Why? Because this is the standard policy that we came up with in order to have a cushion as of the ending inventory. This is what we want left over. We think we're going to sell so much and we want 80% of next month's sales left over. So if we were to multiply that out, the 19.6 times 80%, 15,680, 20,100 times 80%, 16,080, 20,006 times 80%, 16,480. That's what we want in ending inventory at the end of July in this case. And then we're going to say the budget unit sales. We're going to say the budgeted unit sales. We're just pulling these down. There's the 20. There's the 19.6. There's the 20,100. That's what we're going to actually sell during the period. So we're going to take what we want in the ending inventory plus what we think we're going to actually sell. That's how much we're going to need. That's going to be the units that we're going to need, the units available, the units that we would need to produce if we didn't already have some in there from last month. But this is not our first year of operation. So this is what we need to sell plus the ending inventory cushion. We're going to have to subtract out from that what we have in there at the beginning. So at the beginning, we had 16,694. We got the 15,680. That's going to be, of course, the ending number here is the beginning number for the next month. Ending number here is the beginning number for the next month. This is where we're starting out with because this is the ending number for the month prior to our budgeting process here. And so if we subtract this out, the 36,280 minus the 16,694 is the 19,586. The 36,680 minus the 15,680 is the 20,000. The 36,580 minus the 1680 is the 20,500. And that's the units that we need to then produce. So these are how many units we need to produce. Now, the next thing is, well, now we can think about the materials, the labor, the overhead. We're going to look at the materials next time. So if we need to produce, like this is guitars, let's say if we're producing this many guitars, we got to say, well, how much wood do we need to buy in order to produce that many guitars? And you might be thinking, well, how much wood does it take for each guitar? We're going to have to just multiply how much wood it takes for each guitar, and that's how much it's going to take. But same idea is here, and the same idea being that we already have some wood, probably from last month, and we want to have some extra wood in case we have to actually make more than that number, just in case, for whatever reason, in case our budget is different. We want to make sure that we have enough in order to cover the sales that we need to cover. So therefore, we're going to do a similar calculation here for the material. So here's our production budget here. We're going to use the production budget to create the raw materials budget. How much material do we need to buy to make the stuff we're going to produce? So we got the production in units. We're just pulling the production down, the production in units down. So here's the 19, here's the 20, here's the 20,005. The budgets are connected in this way. That's why we got to do it in this order. And then we're going to say materials required per unit. So if we're thinking about guitars, you could think, well, we're buying a plank of wood, and we only need half the plank of wood per guitar. So we can make 2 guitars out of the 1 plank of wood. If we're talking about other types of things, it may mean that we need multiple units of material in order to create the guitars. So it depends what we're making, and so you got to be careful on how many units is it going to take to make it. In this case, it takes less than 1 unit in order to make the product. Therefore, if we're going to make 19,586, half times 0.5, it's going to take 9,793 of planks of wood in this case that we're going to cut in half for each of the units we're going to make. So same thing here, the 20,010, the 20,005 is the 20,250. Then we're going to have the budgeted ending inventory. So this is how much we would have if we didn't want any cushion at the end, but we do. We want to have some material left over. We want to have some wood left over at the end of the month. So we're going to say have this cushion in here. Now the calculation for this, and it's going to be dependent, the problem's going to have to give it to you. In real life, we'll have to put in some policy. The policy here is that we're going to take next month's number, we're going to multiply it times 0.5. So that's the policy of this company. So that's going to be the 5,000. We're going to take in next month's, the 10,250 times 0.5, 5125. And we would have to know October's number, which apparently is 8,000, in order to come up with this 4,000 here. So then, if we then add these two up, we've got the materials needed for production. This is how much we want in ending inventory. So the 9,793 plus the 5,000, 14,790. The 10,000 plus the 5,125 is the 15,125, and so on. So this is the materials required. If we didn't have any in the beginning inventory, that's how much we'd have to buy. But we're saying we did have some in the beginning inventory. And how much is in there at the beginning of the inventory? Well, we started off with 4,925, and then in the next month we've got 5,000. Of course, the beginning inventory is now the ending inventory for the next month. And same here, the beginning inventory for this month is going to be a projected ending inventory for this month. All right, and then we're going to say the materials purchased then is going to be this number plus this number gives us the 9,868. The 15,125 plus the 5,000 is the 10,225. The 14,250 plus the 5,1 is the 9,125. We're going to multiply that times the material price per unit. So how much does it cost per unit? In this case, if we're talking about planks of wood, how much does it cost per plank of wood? This whole thing, we've been looking at units in terms of planks of wood. Now we got to turn that into dollars. And if we just multiply that out, then the 9,868 times the 21 is the 207,224, and so on and so on. And then if we add this up for the quarter, this is the sum in terms of dollars for the quarter. This is the sum in terms of units, in terms of planks of wood or units of material in this case. Hello, in this lecture we're going to continue on with the master budget. We started the master budget last time, so if you haven't seen the first part of this, you may want to look at that first and then move on to the second piece of it. The second piece here is including direct labor, factory over, selling, general and administrative parts of the master budget. We will be able to list the components of the master budget, create direct labor budget, create factory overhead budget, create the selling expense budget, and create the general and administrative budget. Alright, so let's go through the process first. We won't go in detail of here, but we do want to keep in mind the fact that all these budgets are going to tie together, and we're going to do it in this order in order to get to our master financial statements budgets of the income statement, the balance sheet, the cash flow budget. So we're going to start off with the sales budget. Then we need to do the production budget in order to get the units that we need to produce. Then once we have that, we can figure out how much the direct materials we'll need, how much direct labor we'll need, how much overhead we'll need. We can also have the capital expenditure budget at this point, as well as the selling and administrative budget. Then we can have the total cash budget that we will need, and then we can create the balance sheet and the budgeted income statement and the budgeted statement of cash flows. This is the order we need to go through in order to have everything flow in the proper format, because many of these steps need to happen prior to another thing happening. So here we go forward. Now remember that last time we already did the sales budget. So we did that last time. Here's just a recap of what it looked like. We used that sales budget in order to create the production budget, how much units we're going to produce, we needed to produce. And then we used that for step 3 to have the raw materials budget. That's where we left off last time. Now we're moving forward this time. We'll move forward to the direct labor budget. So note we're jumping back to part 2 here. I'm going to use the production budget to help with part 4, which is the direct labor budget. That's the order that we're doing this in. So we have the units that we're going to produce. These are how many units we're going to produce. If we're looking at like guitars, if this is how many guitars we need to produce, we're then going to think about how much labor will we need in order to produce that then. Okay, well in July we're going to say the budgeted production. We're going to have the production is just being pulled down for this calculation. So there it is for July, there it is for August, coming straight down, and there it is for September. So that's how these two budgets are related. The production budget, how much we're going to produce, and the direct labor budget, how much hours are we going to have to need and how much money we're going to have to spend for the labor. We're going to take that, multiply times the labor required per unit. Now we're going to say it takes a half an hour, 0.5 hours. We usually think about labor when we think about paying people hourly, obviously. But when we start to measure things, it could get very precise. You might see something broken out, of course, in terms of minutes. How many minutes does it take to get something done? And just be aware that you'll need a conversion if that happens, because there's 60 minutes and the conversion can be a little bit tricky. So you just got to make sure that when you're thinking about the units of time, the conversion between minutes to hours here, we're just saying it takes half an hour. I'm not putting 30 minutes, we're putting half an hour. And that, of course, lines up nicely to when we have to multiply times the hourly rate. That's what we're going to need. So you also may be thinking, well, what if we pay someone salary and this type of thing? We're thinking about hourly wages in this case when we're thinking about producing the item. If people get paid differently, we might have to have some kind of estimate in order to do a calculation like this. We're going to need some estimates in the budget in order to figure this out. This is the type of area where you can probably picture someone with a stopwatch trying to figure out how long it takes to do a particular process and trying to figure these things out and refine our estimate down. But it will need to be some type of estimate. Alright, so then we're going to say that the total hours needed then is going to be in this case, the 19,586 times the 0.5. Half an hour is the 9,793 hours. The 20,000 times 0.5 is the 10. The 25 times the 0.5 is the 10 to 50. That's how many hours we are projecting out. We will then have the hourly rate, which we're saying is $14 an hour. Again, some people might make more, some people might make less. We could get into a very complicated projection on how much hours it would be in different pay levels, but we need some estimate, and this would be the type of estimate that we would have then. And then, of course, if we multiply that out, if we have the hours times the rate per hour, then we can get the dollar amount. So we got the hours times the rate per hour, we get the dollar amount. The hours times the rate, the dollar amount, this would be the total that we're going to spend in dollars. Again, make sure that if you see something that's in minutes, make sure that you make that conversion to hours in order to multiply it then times what's probably going to be the hourly rate is how it's getting. We don't usually think about the minute rate in terms of pay, so be careful on that. Now we're going to take the direct labor budget and help us to create the factory overhead budget, or we're going to create the factory overhead budget. Now when we think about factory overhead budget, the thing that we need to keep in mind is the fact that usually there's two components to factory overhead. We have some costs that are going to be variable and some that are fixed. We may have some mixed costs even, but we need to break out those two. We need to figure out how are we going to break these things out, how are we going to deal with the variable portion, the fixed portion. The fixed portion is usually pretty easy because that's just going to be the same. We can take last year's numbers usually and just, project them forward. They're not going to change. They're fixed, kind of like the rent. Variable will change in some way. In this example, to reflect this in this example, we're going to take the direct labor hours, which are being pulled down from the direct labor budget here. Direct labor hours, direct labor budget. We're going to multiply that times the variable factory overhead rate. So that's going to be, in this case, 2.6. So that's going to be the givens for this particular problem. Again, in real life, we'd have to be, in a book problem, we'd have to be given this type of information to calculate the variable portion in some way. In real life, we would have to figure out some kind of estimate to accurately figure out what the best estimate would be for the variable portion. This is what we're using here. That gives us the budgeted variable overhead. So the budgeted variable overhead, the 9793 times 2.6 gives us the 25,461. The 10,000 times 2.6 gives us the 26,000, and so on. And then we come up with the fixed portion. Fixed portion is pretty straightforward. It's pretty easy. It's kind of like the rent. You would just say, well, we know what the rent is. It's going to be the same going forward. It's always the same. So when we think about the fixed cost, we can think about what we traditionally often think about when we think about a budget, and that's just, well, what was it last year? It's going to be the same next year. That's not the case for everything we've seen, but that is the case for many pieces, and the fixed portion piece is usually in that type of area. So then the total then would be the variable portion plus the fixed portion. For example, the 25,461 plus the 21 gives us the 46,461. The 26,000 plus the 21,000 gives us the 47,000, and so on and so forth until we have the total in terms of the overhead for dollars of the 141,111. All right, now we're going to look at the selling expense budget. We have the same kind of thing when we think about the selling. When we think about production of inventory, a company that produces inventory, we usually think about the selling and administrative are often the period costs, and they're often like overhead in that they have the fixed portion. The fixed portion is going to be easy because the fixed portion is fixed. When we think about the selling costs, we might think about salespeople's salary or the cost of the store that we sell in terms of rent or in terms of depreciation. Those things are usually fixed, pretty straightforward. We may have the variable portion, however. For example, we could have the budgeted sales times the sales commission. So if we pay commission, that is something that's basically variable in nature, and we'll have to figure out, well, okay, well, that's going to change. That's not going to be something that's going to be straightforward. We're going to need the sales number then, if all sales are going to be commission sales, then we can take total sales and multiply times the commission. If only portion of the sales are commission sales, we're going to have to figure out what that portion will be, multiply times the commission. And if we did that, then we're going to take the sales. 494,400 times 9% is the 44,496, and so on and so forth for July, August, and September. Then we're going to have the fixed portion. So we have the fixed salaried individuals. Theirs is pretty straightforward. We know it's we're going to take their yearly salary and divide it by 12, and we'll get the yearly. So the fixed portion is easy. If we add those two up, we get the totals. For example, the 44,496 plus the 3,500 gives us the 47,996. The 42,336 plus the 3,005 gives us the 45,836, and so on. Then we have the general administrative area. Again, usually fairly straightforward. We're talking about the office in this case, and the office usually have salaried people working there, including the accountants who usually get paid salary, so that's going to be pretty much the same. It's a fixed cost going forward. The rent on the office or the depreciation on the office, usually these are fixed things. Usually this is a pretty easier portion of the budget because it doesn't vary in terms of changes with production. So in this case, we're just going to say that the salaries is salaries, so they're fixed. In this case, 11,000 per month. We just take the total salary divided by 12. That's what people are going to get paid. We do have to watch out, of course, for increases and fluctuations in salaries, but pretty straightforward. Then we have the interest. We're going to include interest in this case. In this case, we have a loan out, and we are currently paying apparently $5,000 of interest. This interest rates are usually pretty fixed as well. So as long as if the loan amount doesn't vary, like if we're not paying off principal, then the interest should be fairly constant on that as well. If we're paying off principal, then we just look at the amortization table and figure out what it's going to be month to month. And that's all we're going to have in terms of the general and administrative. So that's where we're at this point, and we will move on forward to cash and calculating cash and then the cash budget next time. Hello, in this lecture we're going to talk about the master budget part 3. So we're going to go into the cash budget. If you haven't looked at the 1 and 2 parts, you may want to go back and take a look at those first before we go through to the cash budget. At the end of this, we will be able to list components of the master budget and compile the cash budget. Alright, so real quick, we're going to go through the components of the master budget. They need to be done in this order. We've taken a look at most of these up until we get to the cash area. So we have to do the sales budget first. Once we have the sales budget, we know what we're going to produce. Then we do the production budget. Then we can do the direct materials budget, the direct labor budget, and the overhead budget, as well as the capital expenditure could be done at this time, and the selling and administrative. And then we can take a look at the cash budget. So this is where we're at this point. We're taking a look at the cash budget. We're going to be bouncing back to some of these budgets we've done prior in order to compile the cash budget. Then we can take a look at the balance sheet budget, the income statement budget, and the statement of cash flows after that point. And that's what we'll do next time. So just to recap, we have the sales budget. All these budgets, by the way, are ones that we're going to come back to, and we're going to pull numbers from these budgets. So we're going to be bouncing back from the cash budget to these budgets in order to compile the cash budget. So we started off in part 1, we had the sales budget. Then we had the production budget, and then we went to the raw materials budget, the direct labor budget, and then we had the factory overhead budget, step 5, the selling expense budget, step 6, and the general administrative step 7. We're going to be using these numbers for the cash budget. Alright, so we're going to take a look at some quick cash calculations before we get into the actual cash budget. We're going to look at the total cash receipts from customers, and we're going to be using the sales budget, part 1 of our budgets, in order to see what that number would be. Alright, so we have the total budgeted sales. We said we're just pulling these numbers over. Was the $494,400 for July, was the $474,400 for August, and it was the $482,400 for September. And then what we need to do is figure out how much of those sales are on account, how much of it was for cash versus the sales that we're going to receive AR for. In a book problem, they would have to tell you in some way, and this way we're going to give some kind of percentage to have the cash sales portion. In real life, we would of course have to make some kind of estimate how much of the sales will be in cash, how much will be on account. It will vary greatly depending on the type of industry and company that we are in. So, but the key here is that we'll have a timing difference, of course, and we need to figure out when the cash is being received, and that's what we are doing here. So we're going to say that the cash sales are $148,320, which is of course the $494,400 times 30%. We have the $141,120 and the $144,720. So these are going to be the cash that's received for the sales made in July. So that's what we have at this point. Sales on credit then would be the $494,400 minus the $148,320, or of course this number times 70%, because if this was 30, then this would be times 70, and that would be the difference. So we have this number here and this number here. These are going to be the sales on credit. The assumption that we're going to make is that the sales on credit are going to be collected in the following month. So if we made it on credit in July, we're going to collect the money in August. Again, that's an assumption we're making in this problem. The problem will have to give you an assumption. In real life, we'd have to know what the assumptions are. The assumptions can be very simplified or they can be very complex. We could assume that we're going to get paid in multiple months after the sales date, but in this case we're going to assume that any sales made in one month is going to be collected in the following month. Alright, so now we're going to take a look at the total cash receipts from customers using what we just calculated, the cash budget piece up here. This isn't the total cash budget, but it's part of our calculation we just looked at. So we got the current month's sales. That's what we're bringing down. Here's the current month's sales on cash. That's the cash sales. And then we're going to figure out the collections of receivables. So we're going to try to figure out how much cash we're receiving. For July, we're going to say that everything that we had in receivables, which we're assuming happened last month, June, is going to be collected the next month. That's the assumption that we are making. Some problems could have much more complex assumptions. They could assume that we're going to get so much this month and then so much the month after, and we'd have to figure out what the cash flow would be in relation to the sales we make on account. In this case, we're going to say that we received all of that in July, and then in August we're going to receive everything that we sold on in July, And then in September, we're going to receive everything we sold in August on account. That's the assumption we're making. Then we can figure out the cash flow for these months. Then we can add them up. This is the cash sales. This is what we received on account. We didn't make the sales this time. We got the sales from last time. That's where we're getting our cash receipts. That's what we got this month. These are on account. There's our cash receipts, and so on and so forth. And then we can use these numbers to plug into our cash budget. All right, so cash budget. We're going to start off with a cash balance that we started with. That's going to be the $40,000. We're going to get that from the balance sheet from the prior period. So this is the balance sheet from the prior period. We had $40,000 to begin with. So there's the $40,000. And then we're going to add to that the cash receipts from customers. And of course, we just calculated that. The cash receipts from customers in July was the $495.68 that we just calculated. So there's that number. And there's our total cash receipts. So we got the 40 plus the 495.68 total cash receipts. Now we need to figure out the cash disbursements. That's usually the longer process, and we're going to have to jump back to our prior budgets in order to calculate this out. So we start off with the payments for raw materials. Now this one we're actually going to get right from the balance sheet over here, because we're going to make a similar assumption for the payments for raw materials, meaning we're going to pay for raw materials on account, and we're making the assumption that we're going to pay for it, and then we're going to buy it on account and then pay for it next month. That's going to be the assumption. Again, we could have, more simplified assumptions, meaning we just pay for it this month, or we can have more complex assumptions in some problems saying that we're going to pay the payable over a certain amount of time frame. We're going to assume that in this problem that anything that we buy in terms of material, we buy it all on account in the 1 month, and then we pay it off next month. Therefore, in the month of June, we bought all the materials. Everything in accounts payable is for materials that we then pay off in July. So that's why that number is going to go here. So it's going to be 1 month off. Similar concept to what we had with the receivables. Then we're going to have the payments for direct labor. We're going to bounce back to the direct labor budget. Here's the direct labor for July from step 4 of the budget. And if we pull that number over, there's that number here. Then we're going to go to the payments for variable overhead. Once again, we're going to jump back to our variable overhead budget that we have already calculated up in step 5, and the variable overhead is here. So we're just taking the variable portion. You might be saying, why aren't we taking the total portion? Because the fixed portion in this case, I believe, was depreciation, not a cash item, therefore not on the cash budget. All right, so there we have the 25,461. Then we're going to have the sales commission and the sales salaries, which we're going to bounce back to the selling and expense budget. So here's the sales commission, the sales salary. We could have combined them into just selling expenses here, but we're going to break them out in our cash budget. So we broke those out separately. Here those are there. Then we're going to have the general and administrative expenses. Once again, we're going to jump back to our step 7 where we calculated the general and administrative. We're going to look at the salaries. Later, we're going to see where that note is calculated as well. Okay, so there is our general and administrative that we pulled over. And then all this other stuff are going to be other areas that we haven't put a prior budget to. One's going to be dividends. Are we going to pay out dividends to the shareholders? And we're going to have to make an assumption on that. We have the loan interest here. So we have 2 loans out at this point. We're assuming that the interest rate is 0.01 for a month. Not a yearly interest rate, for like a monthly interest rate. So we're saying this 12,000 here, 12,000 times 0.01. That's where this 120 is. We're paying 120 cash on that. And then we've got the loan of 500,000 times 0.01, which we also saw on the general administrative expense. And so there's that 5,000 there. Purchase of equipment. We don't have anything in July that we're estimating, but that's another thing that we'd have to think about. Are we purchasing equipment for cash, the cash portion of the purchase of equipment? Anything that we financed, of course, wouldn't be on the cash budget. Okay, so then if we added all this up, I won't do the calculator, but if we added all this up, we would then come out to the cash disbursements of the 427,177. And then if we subtracted out these two, then we would have the cash receipts up here of 530,568 minus the 427,177, and that's going to give us 103,391. Now I'm going to make another assumption that we commonly do in a problem, commonly do in practice, and that's going to be that we want to maintain a minimum balance of 40,000. That's going to be an assumption that we're going to make in this particular problem. And if we receive more than that, if we're above the 40,000 each month, we're going to pay off the line of credit. So we have this line of credit. That's what this short-term loan is. We're basically saying, hey, if we dip under 40,000, take out a loan. We've made a line of credit in order to do that, to have some security there. And if we go over that that amount of 40,000, then let's pay off the short-term loan. We're over that amount. We're going to pay off the short-term loan, 12,000. And then if we calculate our ending balance, we then have the 530, 568 minus the 427, 177 minus the 12,000, and we have the 91,391 now. Okay, so that 91,391 is the ending balance of July, which will be the beginning balance of August. That's where we're going to start in August. Then we're going to go through the same process again. So we'll jump through a little bit faster here. Same ideas though. We got the cash receipts from customers. I won't go back and pull that, but we're going to pull it from the same place we pulled this. And then if we add these two up, we've got the total cash available. Then we're going to go through our disbursements. So we got first payments for raw materials. Now this number here we got from our balance sheet last time because remember there's a timing difference. This time we're going to have to bounce back to our raw materials because even though we are in August, remember the assumption is that in a cash flow, we're gonna all the purchases we made in July, we're gonna pay for in August. So that's why this number here is what we're gonna pay for in August, and we have to jump back here and pull that number. So just be careful there that we're always kind of a month off here because we're talking about cash flow, which is different than purchases when we purchased it. All the rest of it's going to be the same. So this is coming from the same area. We have to jump back. Same area. We have to jump back and pull these same numbers out. So same process in these items here. And then we're going to say we have dividends. So this problem is going to make an assumption that we did pay dividends, or we're going to pay dividends. We're planning on paying dividends in August. So that's going to be this 10,000 that we would have to add to our budget, our assumption cash dividends in this case. And we don't have the interest on the loan because we paid it off last time. And we still have the 5,000 interest on the long-term loan. And then if we added all these up, we would get to the 445,060. And then if we subtract this out, the 578, 591 minus the cash disbursements 445,60, we come up to the 133,531, and of course we don't have to pay off the loan. We're over our minimum balance of 40, so we're not going to have any loan adjustment there, and we can just pull that number down. And that's our ending balance for the month of August. That then will be, of course, the beginning balance for September. So here's the beginning balance for September. Same process. We'll go through it even a bit faster. So we're going to pull all these numbers over. This came from the same place as this. If we add these two up, we then come up with this, the 607,531. Then we're going to have the disbursements. Once again, this is going to come from the same place that we pulled this out. Just remember that you got that timing difference in terms of when we received it as opposed to when we purchased it. These are just going to be pulled over in the similar fashion, same all the way down. We don't have the dividends this time because that's going to be a separate assumption we're going to have to make. Book problem's going to have to give it to us. Real life, we're going to have to make the assumption. No interest on the short-term loan. We still have the 5,000 on the long-term loan. And now we're going to assume that we had a purchase of equipment of 130,000. So we're going to assume that we're going to purchase equipment in September, 130,000. That 130 only represents the cash disbursement because we're talking about the cash disbursements here. So we have that item. And then if we add all these up, then we're adding all these up. We're getting the 575,691, and that's going to be a preliminary balance of 31,840. And then we're going to have an adjustment because that 31,840 is below the 40,000 minimum we want to have. Therefore, we're going to need a loan of 8,186 so that this 31,840 can come up to that minimum balance we want of 40,000. Okay, so there's our 3 months. If we total this up just to see what the total for the 3 months would be, just be careful if you do something like this. You got to remember that we're starting off at the beginning of the 3-month period. So we're not adding these three up. We're saying, okay, we're starting off at the 40,000 at the beginning of July, and then we're doing the total, for the total 3-month period. Then we're going to add these three up, and then if we add this plus this, we come out to the 1,491,768. And then we can add these three columns up all the way down. So we're adding these three columns up all the way down. If we sum all these up, then we come up to the 1,447,928. If we subtract this number minus this number, the receipts minus the disbursements, 43,840. And we had the total adjustments, which is the 12 minus the 8,160, because we took out a 12,000. We paid off the 12,000 loan, and then we took out another 12,000 loan here. So this is actually a subtraction problem, and we brought this out, and that brings our ending balance to the 40,000, the 43,840 minus the 3,840. So these are broken out per month. This is broken out for the total quarter. Hello, in this lecture we're going to continue with the Master Budget Part 4. If you haven't looked at the previous 3 parts, take a look at those. We'll be continuing in Part 4 with the budgeted cost of goods manufactured and cost of goods sold. We will be able to, at the end of this, list components of the master budget, compile a budgeted cost of goods manufactured, and then compile the budgeted cost of goods sold. Okay, so let's go through the list again, the order in which we need to see the budget. We're going to do the sales budget first. That's going to be the first thing we need to do in order to do the production budget. Once that has been done, then we can take a look at the direct materials budget, the direct labor budget, and the overhead budget, as well as the capital expenditures we may need for that time period, and the selling and administrative budget. Then we can do the cash budget, and then we're going to move on to basically the balance sheet. And we are looking at calculations that will be needed in order for the cost of goods sold section in the balance sheet at this point. So in order to create the balance sheet, we need the cost of goods sold. And in order to have the cost of goods sold for a manufacturing company, we're going to work on the cost of goods manufactured. That's what we'll be taking a look at here. Then moving on to the balance sheet and income statement and statement of cash flows are the statements that could be done after that point in time. All right, then we're going to go through what we have done so far. These are going to be the budgets that we have done so far. Quick overviews, because we will be jumping back to these in order to complete what we are going to do today: cost of goods manufactured and cost of goods sold. So we started off with the sales budget, which looked like this. We then did the production budget in step 2. Then we did step 3, raw materials budget. And then we did step 4, the direct labor budget. And then we did the factory overhead budget, the selling and expense budget, and the general administrative budgets. We have all those pieces now, and we're going to use those pieces going forward. We then made the cash budget using many of those pieces. Now we're going to move forward from that to go to our major financial statements, the balance sheet, the income statement, the statement of cash flows, and we're going to use the next calculation in order to help us out with the income statement portion, which will be the cost of goods manufactured, so that we can use that to get the cost of goods sold, so that we could use that on the income statement. Alright, so here we have cost of goods manufactured. We're going to start off with raw materials. So the raw materials we're pulling from the balance sheet from the prior period. So this is the prior period's balance sheet. Here's the raw materials that we're going to start with. Beginning raw materials will be of course the same as the ending raw materials in the prior period. So we can get that from the financials from the prior period. Then we have the raw materials we're going to purchase. How much are we going to buy? We figured that out earlier, and we did that in the raw materials budget. So we did this budget and we came out to the raw materials purchases here, 611,474, and that's what we're going to put right there. So that's going to be the purchases that we will be then making. And then we're going to have less the raw materials ending inventory. So this is going to be similar to kind of the cost of goods sold calculation you would see in a merchandising company. We have the beginning balances plus the purchases minus the ending balance. And here we're going to do this calculation to figure that out. We could go to the raw materials budget. We're jumping back up to step 3, raw materials budget. We've got the 4,000, that's in units in the ending, and we have the $21 per unit. So if we multiply those together, we would come up with the 84,000. So now we're subtracting out the 84,000. So we're back to the budgeted cost of goods manufactured, where we had the beginning 98,500 plus the purchases 611,474 minus the 84,000 ending balance, and that would give us the direct materials used in the process being the 625,974. Remember, when we talk about the manufacturing of inventory, we're talking about direct materials, direct labor, and overhead. This is the calculation we need to go through in order to get the amount of the direct material that it was actually used in this case. Then we're going to take a look at the direct labor. Might be a little bit more straightforward. We're going to jump back to step 4, which is the direct labor budget, and we'll take the number at the end of the budget for the total of the quarter, 425.99, and that will be the direct labor numbers. Next piece, we're going to have the factory overhead. So now we of course have the direct materials, and now we have the direct labor. Next piece is the factory overhead. We're going to have the variable portion and the fixed portion. We're going to jump back to our budget for factory overhead in step 5 in order to get those two numbers. So we have the variable portion here and the fixed portion. So variable portion, fixed portion, 78,111 and 63,000 will give us the 78,111 and the 63,000 for the factory overhead. That will give us the total factory overhead of 141,111. So now we have our three components in the outer column, that being the direct materials, the direct labor, and the factory overhead. We will then, of course, add those three up. We're going to add this outer column up. So we're adding the 625,975 plus the 425,99 plus the 141,111, giving us the 1,187,685. Then we're going to have the work in process at the beginning. There was none in this case, but we're going to go through this full calculation just to have it here. Then we got the total work in process, which is of course this, and the 0, giving us the same number. And then we have the work in process inventory ending, again is 0 in this case here, and that would give us the cost of goods manufactured. So that's going to be our calculation for the cost of goods manufactured. We will then use that number. The whole point of this is to use that number in the cost of goods sold calculation, which will be needed on the income statement, the budgeted income statement. All right, so we have the cost of goods sold now. Our familiar formula from our inventory type companies, the merchandising companies, still starts off with the beginning finished goods inventory. But then instead of purchases, as we would have if we just purchased inventory and sold it, we're going to put in the cost of goods manufactured, because in this case, we are manufacturing the goods. And therefore, we have to do that full calculation that we had just done, the cost of goods manufacturing calculation, in order to put this in place of where purchases would normally go if we were a merchandising company. And that will give us the cost of goods available for sale. So this would be the amount that would be available for sale if we were to sell everything for that time period. And then we're going to have less the ending goods inventory. So in a book problem, they would have to give you that number. In real life, we'd have to figure out what was going to be the estimate for the ending goods, the finished goods inventory. And that would give us the cost of goods sold. So there we have the cost of goods sold number. We can then move on to the final piece, which is the balance sheet and the income statement. Cost of goods sold, of course, being part of the budgeted income statement that we will need for the creation of that statement. Hello, in this lecture we're going to continue on with the master budget part 5. We're going to continue with the income statement. So if you haven't looked at the prior budgets, you want to probably look at the prior budgets. We'll be using part of them in order to create the budgeted income statement. After this, we will be able to list components of the master budget, compile the budgeted income statement. Alright, so let's go through the quick list once again of the components of the budget. We have the sales budget. We need to do it in this order. We then have the production budget. We then can create from the production budget, which was created from the sales budget, the direct materials budget, the direct labor budget, the overhead budget, as well as the capital expenditures for large projects and equipment we might be purchasing, selling, and administrative budget. We then created the cash budget, the cash flow budget. Then we, in between making our financial statements, such as the balance sheet, the income statement, and the statement of cash flows, we needed the cost of goods sold, and therefore we had to create the cost of goods manufactured. So the cost of goods manufactured and the cost of goods sold calculations have been done in order to help us with the budgeted income statement in that case. Now we're going to move to one of the major statements, of course, one of the major statements that we think of when we think of the budget, that's the income statement, because we're usually thinking about how we're going to perform over time, and that's going to be income statement, the timing of how we're doing. So that's what we're going to move to at this point in time. So let's take a look at all the budgets we've seen so far. We're going to be using some of these in order to create the budget income statement. We started off with the sales budget. What are we going to make? We then use that to create the production budget. How much stuff are we going to produce? And then we use that to see how much materials we're going to need in step 3. And then in step 4, we needed to see how much direct labor we were going to need. And then in step 5, we had the factory overhead. Then the selling and administrative, and finally the general and administrative areas. Then we did the budgeted cost of goods manufactured budget, and we also did the cash flow budget was in there as well. And then the cost of goods sold. Those are going to be the major components we will then need going forward here to the budgeted income statement. So now we are on the budgeted income statement, and first piece will of course be the sales. So the sales, we're going to jump back to the sales budget, and that's where we're going to have the total sales. So we just jump back to step 1, sales budget. That's going to be line 1 of the budgeted income statement. Then we have the cost of goods sold calculation, which of course we have calculated, and we did that in the budgeted cost of goods sold. So remember, that's in the prior recording where we took a look at the cost of goods manufactured, this number here, which we needed in order to create the cost of goods sold calculation. Then we can, of course, take the cost of goods sold number and plug that into our budgeted income statement at this point. Then we're going to have the gross profit. That's going to be the sales minus the cost of goods sold. That will give us the gross profit calculation as normal. Then we're going to have the operating expenses, all other expenses here. Within the operating expenses, we are going to have the sales commission and sales salary. So we're going to pick those numbers up by jumping back to the selling and selling expense budget. So we have these two items. We didn't total them up in this budget, so we'd have to add them up. So we got July, August, September for the sales commission, and July, August, and September for the sales salary. If we added these up and then added these up, then we would come up with the $132.48 for the sales commission and the sales salary $10,005. All right, then we have the general administrative salaries and the long-term note interest, and we're going to pull that from here. So we got the general administrative. This one we did total up for the $33,000 and the 15. We're just summing up the quarter, the full quarter, which is of course the 3 months in this case. So here's the 33 and the 15. General administrative long-term note interest. Then we have the short-term note interest. I'm just going to pull that number in. We did that on the cash flow statement. So you could pick it up from the statement of cash flows where we calculated the interest on the short-term note. And then if we sum these items up, we're summing up the operating expenses. So we pull them into the enter column. If we add these up and pull them out to the outer column, we have the total operating expenses of the $188,868. And now we have the gross profit and the operating expenses. We're going to subtract those two out just as we normally would. $255,335 minus the $188,868 would give us the $66,467. That's income before taxes. Now we're going to assume a tax rate of 35%. We generally break out the taxes separately as a separate line item, even though they are an expense, related to all the other types of expenses, because taxes tend to distort the picture, and we know that taxes vary in relation to net income. So we're usually going to break that out at the bottom here. So we're going to take the $66,467. We're going to assume 0.35, 35% tax rate, and that will give us the tax $23,263. So there's the $23,263. Then if we take the income before taxes minus the taxes, that will give us the net income, the $43,204 net income. Hello, in this lecture we're going to look at the Master Budget Part 6, Budgeted Balance Sheet. If you haven't taken a look at the other 5, you might want to take a look at those first, because we will be using components of those in order to compile the balance sheet. At the end of this, we will be able to list components of the Master Budget and compile the budgeted balance sheet. This is going to be the components here. We started with the sales budget. We need to do it in this order. Sales budget. Then we had the production budget. And then the production budget will be used to make the direct materials budget, the direct labor budget, the overhead budget, as well as the capital expenditures budget, the selling and administrative budget. Then we're going to have the cash budget. Then we can put together the statements, the balance sheet budget, and the budgeted income statement, as well as the cash flow. We also had some other worksheets in order to calculate the income statement. We wanted to calculate the cost of goods sold, and in order to do that, we needed to have the cost of goods manufactured. So that's going to be the process that we're going through in this case. In this one, we're going to focus in on the balance sheet, putting a lot of the stuff together in terms of the balance sheet. Remember, when we think about the budget, we often think about the income statement, how we're going to perform over time. The balance sheet is going to be where we are at as of the end of that point in time. Where are we going to be standing once the budget time period is over in terms of a balance sheet perspective. All right, so we've done this so far. We've already done the sales budget. That's number one. Step one we did. Step two, we used that to do the production budget. Then we had the raw materials budget, the direct materials budget, and then the factory overhead budget, the selling expense budget, the general and administrative expense budget. We used that to create the cash budget here, and then the budgeted cost of goods manufactured, so that we can get the cost of goods manufactured number that we would then use to calculate the cost of goods sold number. We used that to then calculate the income statement. So we've done all that so far. We're going to bounce back and forth to some of these items in order to use them to create the balance sheet. The point we are at the end of the time period, of course. So balance sheet at the end of our budgeted time period. Where do we stand after this time period that we are budgeting for? This quarter is ended. That's what we're looking at. We're going to have the assets will be the current assets. We're going to start off with cash. Cash will be coming from the cash budget. So cash budget, we have the 40,000. That's where this 40,000 is here. Don't confuse that with the 40,000 at the beginning of last time's balance sheet. So this is the balance sheet at the end of last period, which is of course the beginning numbers for this period. The reason it's the same is because, remember, that's our minimum balance. So it happens to be that we needed to take out a loan to get to 40,000. And because that's our minimum balance. So don't get confused that that's the same 40. It's not the same 40. This is the beginning 40. This is the ending 40. The reason they're the same is because we made it the same in order to keep our minimum balance at 40 by taking out a loan. In this case, the loan at the end for that 8,160. All right, then we got the accounts receivable. We're going to have to do a bit of a calculation to figure out what the ending balance in the accounts receivable is. So what we're going to do is we're going to take the beginning receivable, which is going to come from last time's accounts receivable. So we had the balance sheet as of the end of last period, which is of course the beginning of this period at 342,248. That's where we start. And then we're going to add to that the credit sales. So we're going to have to figure out what the credit sales are. A problem's going to have to give you that. In real life, we're going to have to, of course, estimate that. In this case, the problem said that we have 1,447,200 in sales, given by the sales budget here. So here's the sales budget giving us this number here. And we said that 70% of that, the problem said, was going to be on account. Therefore, those are sales that are going to increase accounts receivable. So here's where our accounts receivable started. Then we had the sales on account, increase in the receivable. And then we have the cash collections from credit sales. So we had to figure that out, and we've done that in the past. We did that on the total cash receipts from customers calculation here. And so if we add these up, that's what we received in terms of cash. So of course that's going to be what's reducing the accounts receivable. So if we take this and make it a bit larger like this, we're going to say that the 342,248 plus 346,080 plus 329,280 is going to give us this 1,017,608. And then if we do the calculation, we started off with 342,248 people owing us money plus 101,3040. That's what increased accounts receivable. Those were the sales on account minus what people paid us, which was 101,7608. And that should give us the ending balance of 337,680. 337,680. That's our ending receivable. So we got to go through a bit of a calculation to get that. That's what we're going to be at here on our balance sheet. There's the ending receivable. Next item, raw materials. We're going to take that from step 3 in our budgets, which is the raw materials budget, and we're going to take the ending balance in terms of units here and multiply it times the 21 per unit price, and that will give us our ending balance of the 84,000 in this case. So remember, what we're looking at is where we stand as of the end of the time period. That's what the balance sheet is in terms of the budgeted balance sheet. So we're going to take our ending amount here. That's what we're going to have on the balance sheet at the end of the time period. Then we've got the finished goods inventory. Finished goods inventory we could take from the cost of goods sold calculation where we have here. And this is going to have to be something that's given in the problem. It's going to have to be something that we will estimate in real life, what's going to be in the ending finished goods inventory. And then if we add up the total current assets, then we can take out the calculator here. And that would be the 40,000 plus the 337,680 plus the 84,000 plus the 321,360. Gives us the 783,040. That's our total current assets. Then we're going to have the equipment. We're going to look in, this is a property, plant, and equipment. We can get that from the prior times equipment. We had 600,000. Then we have to look for the stuff that was added or taken away. In this problem, the only thing happened was equipment that was added. It was all for cash. That's why I'm looking at the cash budget in order to get that. If we financed it and whatnot, we'd have to think about find how much equipment we had purchased, whether it was financed or not. In this case, we had the 600,000. We had one purchase through this time period for cash of the 130. That gives us the total equipment, 730,000. Then we have the accumulated depreciation, the stuff we're going to reduce the equipment by. Once again, we're going to take the balance sheet from the last period. So last period's balance sheet had accumulated depreciation, 150,000, and we have the budgeted overhead budget gave us 21,000 a month or 63,000 on the quarter. So the 150,000 plus the 63,000 in accumulated depreciation gives us this 213,000. So then if we take the 730,000 minus the 213,000, we have a book value of the equipment of 517,000. Then we're going to have the total assets being the outer column. So the outer column of current assets, 783.40 plus the 517 gives us the $1,300,040. Then we have the liabilities and equity we're going to move on to, starting with the current liabilities. First one being accounts payable. We're going to go through a similar calculation that we did with the receivable in order to figure out what is in there. Now, this is going to be a bit more simplified because of the way this particular problem was set up. We're basically left with, in the receivable, this number here, the September. But let's go through the calculation a bit in the long way just so we can see how this calculation would work and how you could see it applied to a different type of setup. In this setup, we're saying that we're going to purchase everything on account and then pay for everything the following month. So if we think about this, we're going to say, okay, then that means that there's 200,500. That's what we started off in accounts payable. That's what was in there at the end of last month. That's what's in there at the beginning of this month. And then we're going to say, okay, then we had purchases of raw materials. Remember, the assumption is that we purchased all of it on account. So we purchased everything on account. In this case, for the entire month, we purchased 611,474, all of it on account. So that would increase the accounts payable. Then we have to think about how much payments for raw material. How much did we pay? And the assumption is that we pay the month following. We pay for the full previous month, the month following. So that means that the amount we paid in August, we paid the 200,005, and then in July, we paid the 200,005 that we purchased the month before, and then in August we paid the 207, and then in September we paid this 212 for the purchases. That leaves us then, of course, with this number. So if we add up the 200,005 plus the 207, 224 plus the 212, 625, we come up with the 191. We come up with the 620, 349. And if we then say, let's take out the calculator and actually do the calculation here. So then, if we take the 200,500 we started with, plus the 611,474, minus what we paid, $620,349. We're going to end up with the $191,625 here. And of course, that is the purchases that we made in September. So that's why this one happened to wind up, of course, the purchases that we are left in September, because we're going to pay them all off in the following month. All right, so if we pull that over, there's the $191,625 here. Next, we have the short-term loan payable, $8,160. That, remember, we're going to take from our cash flow statement because that loan is fluctuating. It's kind of like a line of credit. We needed that in order to get to our minimum balance of this $40,000 in cash. And then we have the income tax payable. That's going to come from the income statement. So that's going to be down here on the income statement. We had to calculate the income tax payable. That is what's going to be owed for income taxes on the balance sheet at the end of this time period. Then we have the total current liabilities. That's going to be, of course, this number plus this number plus this number will give us the total current liabilities. Then we have the long-term note payable. That doesn't change. In this particular problem, that was the $500,000 at the beginning of the time frame. We're paying off interest only during this time period, during this quarter. Therefore, the principal does not go down, so we're still at the $500,000. And now we're going to move to the equity section, where we're going to have the retained earnings. So we'll do the calculation for retained earnings, which will be the beginning retained earnings, which we will get from the last time's balance sheet. So last period's balance sheet, ending retained earnings for last period's, beginning retained earnings for this period. We're going to add to that the net income, which we will, of course, get from the income statement. So there's income. We're going to add that to the retained earnings. Then we're going to subtract that from that, the dividends that we paid out. Now, we recorded this in the statement of cash, in the cash budget, so, but I won't go back there, so that's where that $10,000 is coming from. We budgeted the amount that we're going to pay out, and that will give us the retained earnings. So we've got the $208,788 plus the income, $43,204, minus the $10,000 dividends, gives us the ending retained earnings of $241,992, and that's going to be this item here. Then we're going to have the total stockholders' equity, which will be the $335,000 plus the $241,992, gives us the $576,992. And if we then add up the total liabilities and equity, here's the current liabilities plus the note plus the total equity. So these three are adding up to the these three adding up to the $1,300,040. And of course, the total liabilities and equity will then equal the total assets, and so we are in balance in our budgeted balance sheet.